today's topic. We're talking financing today, everybody. Financing. Sometimes we have to put our real estate lawyer hats on. Sometimes we have to put our accountant hats on, our construction hats on. We have to put our psychology hats on. But sometimes we have to play mortgage lender as well, too. We want to know some basic mortgage lending terminology, some basic principles of this. And what this is 22 to 23 questions of your final state exam. This is about 15% of your final state exam. We're going to talk about some general concepts, some sources of financing and different financing instruments. There's a few key parts in today's discussion that you're definitely going to want to know, because I can almost guarantee you're probably going to get a question on it, and I'll point those out to you guys. So let's start off with our general concepts. We're going to talk about economic cycles and different types of loans. You know, especially when it comes to economic cycles, and especially during different presidency changes, the economy shifts with every new election as taxing and spending policies change. We often saw that with when election is upcoming, when Biden took office, when Trump took office, there's that leading up to the election where things kind of settle down, because we don't know, number one, who's going to win, but also, what new policies will they enact once they become president. So the economy often shifts with every new election as taxing and spending policies do change. Inflation and deflation. I know all of you guys have heard this. I know you guys have heard this terminology. Carla, when's the last time you used inflation and deflation in your vocabulary?
Never.
Never?
Not really.
Probably more often than the random stuff I throw at you. But inflation is the result of too much money chasing too few goods. Often see this with lack of inventory. 2021, big year for real estate. The demand was super high. People wanted to buy. Interest rates are super low. What we are experiencing, especially the overall economy, is inflation. The lack of inventory right now in real estate in today, 2023, is what we are seeing. There's not a lot of sellers. There's still a ton of buyers. Even though interest rates are higher right now, homes are still selling over list price. There's still 40 people at an open house. Inflation is a result of too much money chasing too few goods. And then we got deflation, is when prices of real estate goods and services go down. We did see prices decrease, from May of last year till now. They're holding steady right now. In 2008, 2009, we saw prices just drop, at that time. Can anybody remember a time when there was too much housing inventory? It's been a while. It's been a while. 2008, 2009.
Yeah, 2008. I was going to say 2008, 2009.
Yeah, there was a good amount of inventory. There's a lot of homes for sale. Financing was not super easy to get. The overall state of the economy was difficult. But just knowing those two terms, inflation, deflation, knowing the basic principles, is going to help you answer some questions on your real estate exam. Jump over to discount points. Discount points is a percentage of your loan paid to adjust your interest rate. So if you're at a 5.75 interest rate and you want a little bit lower rate, often you can buy down your rate. We call it, you can buy down the rate. So instead of 5.75, maybe you want 5.25, and the cost for that you'll pay up front, you would pay, let's say, 2 points. And when they say 2 points, every point is equal to 1% of the loan amount. So if you're borrowing $400,000, 1% of that is $4,000. This is the extent of the math that you will do on your final real estate exam. You will be provided a calculator at your final real estate exam, but this is the basic percentages that you're going to need to know. 1%, 3%, but discount points is 1% of the loan amount. So how much ever that person is borrowing, if they're borrowing $6,000, a discount point is 1% of that loan amount, which would be $6,000. So if you're paying 2 points, just multiply that by 2. That is the percentage of the loan paid to adjust your interest rate. When you apply for a mortgage, there's typically a loan origination fee, and this is the fee charged by the lender in order to apply for the loan. This could be a flat rate. It's typically 1% of the loan amount. So if Uriel was buying a $700,000 piece of property, he's putting $200,000 down. That would mean that he's borrowing $500,000. And if his loan origination fee is 1%, well, he would pay $5,000 as an origination fee. That is the fee charged by the lender in order to apply for the loan. I often talk about word association. If you hear the word usury, that's the maximum. That is charging more than the legally allowed percentage of interest. This is unfair, excessive, over the limit, unethical. You're going to ask me to use it in a sentence. The lender was accused of usury for charging the borrower an interest rate of 12% on the mortgage loan. The word usury should stand out as maximum, excessive. That is a high interest rate is what should pop into your head, and that's usury. I have an example question that I'll show you guys in just a second, but discount points, loan origination fees, and usury is the vocabulary that we want to pay attention to. Let's talk about different types of loans. We have 3 different types that we want to know. We want to know a straight loan, we want to know an installment note with balloon, and we want to know a fully amortized. So with a straight note loan, so we have 3 different types of loans. Let's first focus on this straight note. So this straight note is when a borrower repays the principal, the amount that they're borrowing, in one lump sum at maturity, while interest is paid in installments or at maturity. So if Carla was buying a loan and buying a home, and she was, one of the loans that she got was an interest-only loan, she wouldn't be paying down that principal, how much she's borrowing at all. She would just be making interest payments. This would be an example would be an interest-only loans. The monthly payments are towards the interest, not the principal. So the balance isn't going down at all. She's just paying the interest. The interest-only loans were very popular in the early 2000s, before the Great Recession. Some of you likely took advantage of these types of loans. I did. Or if you didn't, you know somebody who took advantage of these types of loans in the early 2000s. So when you see straight note, I always think of the 80-20 mortgage loan. Like I said, these were the early 2000s, 2007, just right before the recession hit. And these types of loans were very popular because it allowed borrowers to purchase property, but no money out of pocket, and they didn't have mortgage insurance. But that 20% that they borrowed, they were just making interest payments on it. So let me show you this example. So Carla, you just purchased a property for $500,000, and imagine this is the year 2003. That's 2003. And you buy a property for $500,000, you get 2 loans. The first loan would be for 80% of the purchase price, which would be for $400,000. So you would have a fixed rate loan for on the balance of $400,000, and you would have a probably 7-8% interest rate. This is 2003. You would also have a second loan. The second loan would be for 20% of the purchase price. In this case, it would be for $100,000. This loan would typically be on a variable interest rate, meaning that rate could go up, it could go down depending on a period of time. And a lot of these loans were, they were fixed for a certain period of time, and then at 3 years, they would adjust. But you would still be making monthly payments to this, but they would just be going to interest only. These would be your straight notes. Another example of a straight note would be like a hard money loan, and hard money loans are used by investors a lot. And so if AmeriCorps wanted to invest into a property, she wanted to flip a property, she might go to a short-term hard money loan lender where she would get a loan for 500,000 at 10% interest rate, and it would be due in 8 months. She wouldn't make any payments, but it would be due in 8 months. That would be just another example of a straight note loan. Straight note, I think if you're going to think of straight note, just think that you're not paying any principal. You're paying the interest, and it'll be due. Let's talk installment note with a balloon payment. The balloon, just think that thing's going to pop. Yeah, that thing's going to be due at one time. This is periodic payments of principal and interest with a large payment at the end. This is common in commercial real estate. Here's an example of one. This is an example of an installment note with a balloon payment example. So we have a Diana who wants to purchase ABC building for $1 million. She's going to put 20% down. That means she's going to borrow $800,000. Interest rate's going to be 8%. Principal and interest payment's going to be $5,000 a month. With this balloon payment example, you'll often see it where the monthly payment is calculated over a 30-year span, right? Over 30 years, but the loan has a balloon payment and it's due in 10 years. So her loan is only really for 10 years, but the way that it's calculated over 30 years. The reason this is so that she has a lower payment for these 10 years, but at that 10-year mark, the entire amount is going to be due. The entire amount is going to be due. So she's going to have to make that one giant lump sum balloon payment. Installment note. So every single month she's making principal and interest payments, but she's going to have one giant payment due at the end. In this case, it would be 10 years. Questions on this? Everybody follow those two small differences between the straight note making payments only to interest, and this one just having a one lump sum payment, but you're still making principal and interest payments. That's this one. Installment note, balloon payment example. And the third one is a fully amortized. If you have a mortgage, you likely have a fully amortized. This is the one that's making principal and interest payments all the way throughout your entire loan term. So if I use this same example, if I take this same example from previously, on $1 million at an 8% interest rate, the principal and interest payment is about $5,000, by the way. I didn't include taxes, insurance, but the principal and interest payment on an $800,000 loan, principal and interest is about $5,000. A fully amortized loan looks like this. Can't you pay extra for the principal for straight notes? But it's a straight note. Can't you pay? Well, a straight note, you would be paying only the interest. I'm sure you could. So your fully amortized looks like this. So if Diana was borrowing $800,000 on an amortized loan, fully amortized loan, her first payment of $5,000, $777 would go to principal, $4,083 would go to interest, and this would be the balance. If you notice, every single month, the balance slightly goes down a little bit every single month because every single payment, more principal is being paid. A little bit more every single month. And every single month, a little bit less interest is being paid. When this is year 1 and this is year 2, by the time it gets to year 30, the balance will be a lot less. So there'll be more principal being paid and less interest because the balance is low. And that's a fully amortized loan. Carla, you got it?
I do.
I'm going to quiz you on it. You ready?
No.
Okay, I'm just kidding. I'm not going to quiz you. Straight note, installment note, and fully amortized. Those are the three. You'll get some questions, and your questions, and I'll show you what one of those questions might look like. But what is the closest definition of the term usury? Illegal rates of interest. Remember, that's maximum, excessive, way too high, taken advantage of. Usury. You got used. You can use it that way. If that's how you can memorize it. But this is kind of how the question would look like. What's the closest definition of the term usury? Not lending money at a fluctuating interest rates. That would be more variable. Being capable of multiple usage. I don't know what that means. Making loans without the benefit of cosigners. No, it's illegal rates of interest. Illegal rates of interest. Usury. So a borrower takes out a mortgage loan that requires monthly payments of $795.47 for 20 years and a final payment of $22,745. What kind of loan is this? It's the final payment should be your the Q. So you make payments for 20 years and then you have a final payment. Change final payment with balloon. And that's why the answer would be balloon. They're tricky on their wording. Installment note with balloon, straight note, fully amortized. The answer would be D, balloon. In terms of comparison between a straight note and an installment note, the straight note can be described as. So when you do your final real estate exam, you have 3 hours and 15 minutes to take your final real estate exam. You have to answer 150 questions. And you'll often find these questions that are a little bit more elaborate, like they have longer answers. You guys have plenty of time. Carla, when you took your exam 3 weeks ago, did you take any breaks?
No. I mean, you could, and there's students that did. I mean, yeah, other people that did, but I didn't.
Did you skip a few questions?
Yes, absolutely. Sure did.
Were there any questions on your final exam where you're like, I have no clue what it is, but I read all the answers and I was able to get rid of a couple to figure out?
Yeah. Yeah, definitely. That was recommended by you to leave out the ones that aren't related to the question.
And that's where it's something like this, where they all start with will have. They all, in my eyes, they all kind of mesh together. And it's like, dang, which one is it? This is where we got to like really slow down and just say, I'm going to read every single one of these answers. If you do that, you'll often get rid of one or two of those that you just know by studying that, nope, those are not the answers. And then it usually narrows down which one might be the actual answer. In this case, in terms of comparison between a straight note and an installment note, the straight note can be described as will have no principal payments during the term of the loan except on the last payment. We know that straight notes aren't going to pay principal. They're going to pay it in one lump sum at the end. This one says we'll have the total effective interest rate greater than if the loan were an installment loan. We'll have the greatest effective interest rate. We'll have an equal annual principal reduction payment. We know straight notes don't have that. We'll have all principal payments during the term of the loan. No, we know straight notes, interest only, pay it at the end. After you review each question, each answer, A will be the correct one because that one has no principal payments during the term of the loan. What is the percentage of points that a lender is charging on a $450,000 loan if the borrower is required to pay $18,000 for points? Oh, this one's going to have to make you do some division too. So we have to figure out how much is it cost per point. So 450,000, 1% of that is, Carla?
4,500.
4,500, take 18,000 divided by $4,500 a month is 4 points. Okay, that's the extent of your math. So division and multiplication. And percentage too. 6th grade math. Yeah. So let's talk types of lenders. Let's talk different sources of financing. Let's talk different types of lenders. We need funds to build, to finance or purchase, and for refinancing, right? There's 3 types of lenders. especially for our real estate exam. We want to know institutional lenders. We want to know non-institutional lenders. And we want to talk about government-backed loans. So let me describe to you guys an institutional lender. And an institutional lender is a large corporation that lends depositor funds to finance real estate transactions. Can anybody name a large corporation that lends depositor funds? What's that one bank called? Large bank. Actually, how about this? How about just name 3 large banks?
There you go.
Wells
They're in the chat
Fargo,
now.
Bank of America.
There you
Thank
go.
you.
They're putting them
There
in
you
the
go.
chat now.
Is it Wells
Yeah.
Fargo?
Chase.
Boom, Bank of America, Chase, Wells Fargo. So let's just like keep this simple. Let's just consider these are large institutional lenders, right? So federal savings banks, they do provide real estate loans, more real estate loans than any other financial institution. They're either federally or state licensed. They can loan 80% of the value of the property to be purchased. These are big institutional lenders. These are big banks. A lot goes on behind the scenes. But for our real estate exams, we just need to know that these are large institutional lenders. They can lend 80% of the property value. They can also lend 90% or 95% of the property value. They're just protected with something called private mortgage insurance, PMI. I'm sure you guys might have heard that term before. Just know if you put 20% as your down payment, you put 20%, you won't have that PMI, that private mortgage insurance. And private mortgage insurance doesn't really protect you, the consumer. It just protects the bank in the event of you defaulting. But mortgage bankers will often write these loans, and they'll often sell these loans to the bigger banks, Bank of America, Chase. I don't know how many of my clients end up with Bank of America or Chase. They're just better suited to collect payments for a longer period of time. And these banks are the ones that will ultimately finance them. These bigger banks are general purpose lenders. They don't lend on just houses. They lend on jet skis, cars. They lend on line of credits. Their state banks may be the members, of the Fed by choice. They'll loan on first trust deeds. They'll loan on home equity line of credits for homeowners. Those are your big banks. We also have life insurance companies. These are conservative lenders specializing in large equity participation for commercial projects. So if you see commercial lending, if you see life insurance, those two are going to go together. Commercial loans, because like commercial mortgage bankers are much different than residential. They focus on these bigger projects, commercial projects. And usually when it's commercial projects, it's usually a life insurance company is the one that is lending on those. Those are large. These are institutional lenders as well too. Let's talk construction real quick. Let's talk new buildings. Let's imagine you have this empty desert. You're in the beautiful city of Menifee. But I think of desert, just empty land. And you have this beautiful vacant piece of land at the foothills and you want to build 100 houses. You can take out a construction loan. You can take out a construction loan to help you build that structure. And this is an interim loan. This is a shorter period of loan. You're going to build those houses, and then you are going to take a takeout loan. So this takeout loan will replace this construction loan. This is the repayment of an interim loan. And this is used for buildings, construction building, new construction. So have those two, basic vocabulary in the back of your mind. You see takeout loan, you see construction loans. We're talking builders here. We're thinking builders. That's what we have to think of. The construction loan is to build the structure, but that is only for a short period of time. Instead of me refinancing for a new loan, I'm going to take out a takeout loan, and that's going to replace my original construction loan. This is the repayment of this loan here. FDIC, you guys are in the bank, you guys have the tellers, the government corporation that insures an account of depositors up to $250,000. You guys have seen that. That's the Federal Deposit Insurance Corporation. It's going to protect those depositors up to 250,000. And let's jump to non-institutional lenders. Non-institutional lenders. These are individuals or organizations that lend on a private or individual basis. So we have the Bank of America, Chase, Wells Fargo. Those are their institutional. Now we have our non-institutional. These are investment companies. These are credit unions. Credit unions have good rates. They do. I'm a member of Schools First Credit Union. They do have good rates, but they have limited programs. They only have their programs for their members. It's a little bit more private. One of my clients is a member of Navy Federal Credit Union, and active military or not active military, but active Navy, had to been in the Navy, and their family members. When my client bought a home, he had no mortgage insurance. He had super low rates, no money down. And it was just because he was a member of the Navy Federal Credit Union. He had this incredible loan program that I thought he was lying about, but he totally did. And it was just because he was a member of Navy Federal Credit Union. So they do offer good rates. They're just limited on their programs and limited on who they will allow those programs to. Another non-institutional lender would be a private individual. If you guys have ever heard of seller financing, that is, when the banks aren't lending in different markets. I've never encountered this in my 14 years of being in real estate, but when banks have these high interest rates and sellers need to sell, sometimes the seller will basically be the bank for a period of time, and they'll finance the property. So maybe Diana wants to buy Carla's property and she doesn't have all the money down or whatnot. Maybe Carla will play the bank for 3 years for Diana, and then in end of 3 years, Diana will just pay Carla back. But for those 3 years, Carla is collecting payments and she's putting together paperwork to be the bank for that financing. So those could be private individuals, could be non-institutional lenders. And then more often, and this is what we majority of the time here use, are mortgage bankers. And these are banks. These are smaller individuals who specialize in mortgage loans. We have banks like Premier Mortgage Express, Altura Home Loans, Elite Mortgage Pros. These are the 3 affiliated mortgage lenders that we use in our brokerage. And if you've never heard of these companies, it's because they don't do checking accounts and savings accounts, because they do one thing, which is mortgage loans. They work with us real estate agents. They work with the buyers. They have more options. They send their loans to Bank of America, private investors. These mortgage bankers usually lend their own money and roll it over so they can originate, finance, and close first trust deeds and mortgages secured by real estate. These companies like Premier Mortgage, Elite Mortgage Pros, they usually don't have the setup to collect payments for 30 years. What they'll naturally do is they'll take 100 loans and then they'll sell them. They'll sell them on the open market to bigger institutional investors like Chase, Bank of America, Wells Fargo. But mortgage bankers are more flexible in processing mortgage loans. These are non-institutional lenders. We discussed a little bit earlier about private mortgage insurance. So we have different types of loans. We have the insured conventional. That's when 80% of the purchase price is borrowed when it's over. So if someone's putting down 19%, they are going to have some type of mortgage insurance. That's this one here. This is borrower paid insurance. Ensures the lender that if the conventional loan will be repaid if the borrower defaults. So PMI, private mortgage insurance, it's not the best thing, but it is an extra fee. And if you don't have 20%, you're going to pay PMI. Not the worst thing, because your property's going to appreciate anyway. So refinance that when you have more equity. And that's PMI, private mortgage insurance. So let's talk government-backed loans. Government-backed loans are backed by the government. They're insured or guaranteed by a government agency. FHA loans. FHA loans are often considered first-time homebuyer loans. They're not really first-time homebuyer loans. They're primary residence loan. So when you get a FHA loan, it is a loan that you are getting because you plan to occupy that residence. They're not a lender, by the way. The Federal Housing Administration is not a direct lender. They only set the guidelines for this type of loan. With this loan, you could do 96.5%. So you only need 3.5% as a down payment. I would definitely say out of 10 first-time home buyers that I'm working with, I would definitely say that 80% of them use an FHA loan. The FHA guidelines are much more lenient than a conventional. You only need a 580 credit score to qualify for this one. 3.5% is the minimum down payment. You will have mortgage insurance on this loan, but it's not mortgage insurance. It's maximum mortgage insurance insurable. They call it more. It's called MI with FHA loans, mortgage insurance instead of private mortgage insurance. It is designed for first-time home buyers, but anyone that qualifies can utilize this loan as long as you plan to occupy it. This one is used for 1 to 4 units and the 3.5% down. Keep that in mind. So you can buy a duplex with an FHA loan. You can buy a triplex. You can buy up to 4 units. And that's definitely advisable. I think that's a great thing to do. Buy a fourplex, live in 1 unit, rent out the other 3. Couple years down the line, sell or refinance it. But FHA loans are good. And one of the things that have recently changed with FHA loans is that they lowered the cost of mortgage insurance on this. A year ago, if your mortgage insurance costs $300 per month, it's only costing about $180, $200 now. And this is a good thing. This just happened like 3 weeks ago. And these are all attempts to help people buy real estate. They're helping people buy real estate when prices are still super high and rates are super high. They're trying to do something. But that's FHA loans. FHA loans, remember, this is for 1 to 4 units, primary residence, and this one only needs 3.5% down. And these loans are backed by the U.S. government, by the Federal Housing Administration. We have VA loans also that are government backed. VA is not a direct lender. Like you can't go to the VA bank. VA is not a direct lender, but they set the guidelines, right? This is military. This is a benefit of any person to have served. Good program, absolutely great program, because it is 100% loan to value, meaning zero money down. When it comes to VA and what you need to know, I need you to know CRV. This is be important. I need you to know certificate of reasonable value. If you were using an FHA or conventional loan, you would be getting an appraisal on the property. If you were using a VA loan, you'd be getting a CRV, a certificate of reasonable value, which is basically an appraisal, but for a VA loan. It's just that language. There's a quick question in the chat. How is PMI cost usually determined? If it's PMI is the cost for a conventional loan is based upon the amount down and the credit score. For FHA, it's a standard amount. There's no, depending on what your credit score is, it is a standard amount. For mortgage insurance for FHA, for conventional, it is based upon how much you're putting down, the loan amount, and your credit score. There's a few factors. It could range from $120 a month to $400 a month for that PMI. So on VA loans, CRV, Certificate of Reasonable Value. That's basically the appraisal for VA loans. Let's go secondary mortgage, the trust deed market, also known as warehousing. So let me jump back into just a few slides. So remember these mortgage bankers, right? These mortgage bankers is they're gonna help Carla buy a property. They're gonna give Carla a loan. They gave Carla a loan. She has her loan. She's making mortgage payments to Altera Home Loans. About 6 months into her in her new home, she gets a nice little letter that says, "Hey, Carla, hey, we sold your loan to another bank. Your rate's going to be the same. Your payment's going to be the same. But hey, you're not going to pay us anymore. You're going to pay the new bank." I'm sure that's happened to a lot of you guys. It's probably happened several times. You probably get annoyed every single time and you're like, ugh, now I have to change my auto pay. The reason that's happened is because that bank has sold your loan to another bank. And that's sold on the secondary mortgage or the trust deed market. These provides an opportunity for financial institutions to buy and sell from first mortgages to other financial institutions. It's called warehousing. So your loan has been sold to another bank, same rate, same payment. You're just making a check out to someone differently. That's called warehousing. And then we have our private and quasi-governmental corporation. These are the corporations that are used to buy and sell trust deeds between financial institutions. You've likely heard of Fannie Mae, Ginnie Mae, and Freddie Mac. Fannie Mae, Ginnie Mae, Freddie Mac. We have FNMA, Federal National Mortgage Association, Government National Mortgage Association. And this is just the lender talk where they sell these loans and use government-backed money. Ginnie Mae, Freddie Mac, Fannie Mae. So here's a question. When referring to mortgages, the term warehousing means, I just said it like a minute ago, selling loans on the secondary market. That is what that is. That's another definition of warehousing, is selling loans on the secondary market. Which of the following is not a characteristic of federal housing? The not questions are always is another one where you got to slow down, because now we have to read all the answers and determine which one is not a characteristic of FHA. So let's go through the answers here. A mortgage insurance premium is charged. We know that is charged with FHA. So that is one characteristic for FHA. They're going to charge mortgage insurance. You can put 20 or 30%, you can put 50% down on FHA. You will still have mortgage insurance. You can put 80% down. You will still have mortgage insurance. If you're putting a substantial down, you're not using FHA. There's one advantage of FHA though. If you had bankruptcy 2 years ago, you can use FHA 2 years later. Whereas conventional, you have to wait 4 years. So that's one advantage. The maximum debt is determined by a formula. Yeah, that's true. There's a formula that's used for FHA. The lender is insured against loss. Yes. And that's insured by the insurance. The one characteristic that is not FHA, FHA provides the money for the, FHA does not provide the money for the loan. They provide the guidelines. They're the administration that provides the guidelines. They do not provide the money. The institution, the lender, the banker is the one who provides the money for the loan. So that is not a characteristic. To obtain an FHA loan, where should a buyer be referred by the broker? The FHA, the Federal Housing Administration Office? No. Fannie Mae, the Federal National Mortgage Association? No. And an appraiser in the area? No. Any approved lending institution, such as a bank or savings and loans association, that's where someone would get an FHA loan. You can go to your Bank of America's, your non-institutional lenders as well. You can go to a mortgage banker. You can go to Quicken Loans, Rocket Mortgage, all those ones. You can get an FHA loan there. Or you can just go into Google and just type in FHA loan, and you'll be solicited by 50 billion mortgage lenders through email and tracking you through the internet for the next 30 days. But you'll never get it from the FHA office. You'll get it from one of the lending institutions and banks. Let's go financing instruments. We're rolling along here. We ran a little bit early. Carla, hi. So Carla wants to borrow money to buy a home. So let's just say a borrower wants to borrow money to buy a home. Before the lender will give Carla money, the lender wants the buyer to sign a promissory notes. It's basically an IOU. It's a piece of paper. It's evidence that the bank gave you money. This is one of those. So what we're going to go over right now is one of those core key concepts that you got to know for your exam. We're going to talk trust deeds. We're going to talk mortgages, but promissory note it's a piece of paper. It's proof that someone owes a debt. It's a promise to pay. It can be passed from one person to another. Like I said, it is an IOU. Now, this promissory note is going to need a security device. And this names the property as a security. This names the address 123 Main Street. This is the collateral, the property named in this promissory note. This is a receipt. This is you at Costco that before you walk out the door and they use a little highlighter, it says the property address on that receipt. This is, and it varies from state to state, but some states will use a mortgage as this security device, and some states will use a trust deed or a deed of trust. In California, we use a deed of trust, a trust deed. And there's a small difference between the two, and this is going to be an important distinction to make between the two. So a security instrument is a legal document giving a bank or a lender a security interest in the property. All right. So when we think of mortgages, and this is where a lot of people get confused because we're like, well, I have a mortgage. Yeah, you have a mortgage to pay the bank, but the way that your property is held, it's not held as a mortgage. It's held as a trust deed. Let me explain what I mean. So mortgage is a financial instrument in the form of a lien that secures property for payment of a promissory note. This is rare in California. I really should just get rid of rare and just say not used in California. We don't use this in California. But a way that it works is like this. Who am I going to use? Let's use Nick. So Nick is the borrower. Nick is the borrower. Nick will sign the promissory note and the mortgage. Want to buy a property? Cool. You are the mortgagor. Actually, all of you guys will be the buyer. You guys are the buyers, all right? You guys will sign a promissory note saying, hey, give me money and I promise to pay you back. In this piece of paper, we're going to name the property on the mortgage. We're going to name 123 Main Street. So the borrower will have full legal title. The bank, let's just call them Bank of America, they are going to hold on to this note, this piece of paper, this IOU that says, Nick, Carla, you're going to pay me back. They're going to hold on to that mortgage as well, too. I think one of the bigger differences between trust deeds and your mortgages is when it comes to the foreclosure process. So if we are in a state that uses mortgages, if the bank has to foreclose on you, this is what's going to happen. In the event of foreclosing on a mortgager, it's expensive and it's time consuming. It's called a judicial foreclosure. The bank, if they want to foreclose on you, and if they want to foreclose on you, they have to go through this court process. They must file a lawsuit, obtain a court order to foreclose on the property. This could take a longer period of time. It's also costly because they got to get the lawyers involved as well too, right? Because there is only the bank and you, judicial foreclosure. So let's shift that over to a trust deed. So this is what we use here in California. So this is commonly used. This is only used in California. There's 3 parties to the ownership of your property. So Carl, I'm going to use these as an example. You are a homeowner. You are the trustor in this case. You are known as the trustor. And this part's going to be important for you to be able to differentiate who is who. The borrower is called the trustor. The borrower will sign the promissory note and the trust deed. You're going to sign this IOU that says, hey, give me money, I'll pay you back. I promise you. You're going to sign the trust deed that names the property, 123 Main Street. The title company, it's kind of like the third party. the title company is representing the bank. The trustee is going to hold that piece of paper. They're going to hold that piece of paper and say, oop, all right, Carla is going to pay us back. We have this trust deed that says, okay, this is the property. And this title company is going to represent the beneficiary, which is the bank, which is the people who lent Carla the money, that lent the borrower the money. The bank will provide the money and the bank will collect payments. So when Carla makes her mortgage payment every single month, she's not paying the trustee, she's paying the bank. But the trustee is the one that's representing this bank. They're the one holding this piece of paper. So let's fast forward. Carla, sorry, I know you're in rough times and you're losing your house. Now foreclosure has began, right? So in the event of foreclosing on a trust deed, it's a non-judicial. It's a private foreclosure would take place, which does not involve the court system and can be completed by the third party, such as the trustee. Have you ever heard the term notice of trustee sale? And the notice of trustee sale occurs when somebody hasn't made payments on their home for 6 to 7 months. A trustee sale is where you can go to the courthouse and raise your paddle and buy trust deeds. And these are foreclosures. When people say, I want a deal because I want a foreclosure, yeah, go to the courthouse and raise the paddle and pay cash for a property that you don't see. There's a huge amount of risk in this. This trustee is representing the bank. The bank, if you don't make your mortgage payment for 3 months, the bank is going to say, hey, trustee, Carla hasn't made her payments for 3 months. Start the foreclosure process. And that's what will happen. They'll start the foreclosure process, which is also called a notice of default. You guys can all go in Zillow right now. You can go to homes for sale and change the toggle to pre-foreclosure. You will see everybody who's been late on their mortgage payments and who has started this foreclosure process. And this is the small difference, the difference between these two. It's not even a small difference. When it comes to the differences, when it's talking about a mortgage, there's 2 parties. When we're talking trustee, there's 3 parties. This page here is important. This page is important for you to just know what the difference is between mortgage and a trust deed is. Trustee is going to have a trustor, title company, and the beneficiary. Trustor, trustee, beneficiary. Those are the 3 parties. Mortgagor, mortgagee. In this one, this is the one that we use in California. This is other states use this. Mortgage requires a judicial, long, costly, expensive foreclosure. This one is a much quicker process, does not need the court. We got to know it. We got to know it. By the way, you're a homeowner, you have a trust deed. Just letting you know. A lot of definitions, a lot of vocabulary in today's. We have a holder in due course. This is one who has taken a negotiable instrument from another in good faith without knowledge of defect. Carla, you are bank number 1. Uriel, you're bank number 2. All right. Carla, you have a loan and you're going to sell it to Uriel. Uriel would be the holder in due course. He would be the bank that accepts a trust deed, a negotiable instrument, a trust deed, without knowledge of defect, without knowing any issues. You're just going to buy it from Carla. Uriel would be the holder in due course. It's that person purchasing that trust deed. In mortgages, there's something called an alienation clause due on sale. The entire loan becomes due or payable when the property is sold, assigned, transferred, or otherwise alienated. All our mortgage loans have alienation clauses, which means if Carla took out a mortgage on a property and she doesn't own the property anymore, that loan is due. That loan needs to be paid off. When you guys sign your final paperwork with the notary, that stack of paperwork that's like this thick, if we were to do Control F and search the word alienation, or due on clause, it's going to be in that packet. It's going to say if the borrower ever relinquishes rights of this property, the loan becomes due and they have to pay it. So if you don't own the property anymore, there shouldn't be a loan against that property in your name. That is an alienation clause. There's prepayment penalties. Prepayment penalties is, sometimes they don't usually have a lot of them, but some loans do. Sometimes that's how the banks make money, is by interest. So if you took out a loan today, March 25th, 2023, and 2 months later you paid off that loan in full, the bank only collected interest for 2 months. They're going to be pissed. Loans may have prepayment penalties, which is just a penalty if you pay it off before a certain period of time. Assumption is buying a property that is already encumbered and accepting responsibility. So you're basically taking over someone's loan. Accepting responsibility with the lender's consent for the full payment of the loan. Carla has a loan for $300,000 on her property. And, maybe instead of me going through the entire process, Carla, we connect with your bank, and I tell your bank, whoever you're making your mortgage payment to, that I want to assume your loan. So we go through a process, and I assume Carla's loan. I will now have this debt of $300,000. That's assumption. That's assuming someone's loan. Whole process for that, but that's what the definition is. In your stack of mortgage papers, you will also have something called an acceleration clause. An acceleration, just use that word, acceleration. It accelerates, makes it move faster. Upon the occurrence of a specific event, the lender has the right to demand immediate payment of the entire note. Maybe you're not paying your property taxes, not having homeowners insurance, or fraud. I'll admit, I committed fraud in 2009. Yeah, 2009. I committed fraud. I oddly say that while I'm on recording, right? So the property that I bought in 2009 with my real estate agent, he said, hey, just buy this property and just say that you're living there. Keep the utilities in your name. Make sure you make your payments. The bank will never, ever know. So I bought the property as owner occupied. But if the bank, after I bought that condo in Long Beach, if the bank came and knocked on the door and they said, hey, can you speak to Ben Gomez? And they're like, oh, Ben Gomez doesn't live here. He's the owner. He's the owner. He's never lived here. Because I committed fraud and said that I was planning to live there, the bank could call that amount due and accelerate payment for that entire loan upon occurrence of a specific event. Subordination clause. Your loans are going to have subordination clauses, which means they can change priority. So if you have 2 loans on a property, this loan is number 2, this loan is number 1. If loan 1 gets paid off, what happens to loan number 2? It becomes number 1. So there's clauses that allows for future change in priority of financial liens on a property. That's what that is. And taking title subject to. This is buying a property, taking over payments of an existing loan on behalf of a seller who is responsible. So I had this conversation 2 weeks ago. I have a friend, Mark, who has a property in Pomona. He has this 2.875 interest rate. And I had a friend, Kyle, was like, what we can do is a subject to loan. You keep the loan in your name. I'll pay you $300,000 out of pocket, but we keep the loan in your name. And the reason why he would want to do that, because if he got a new loan today, he would have super high interest rate. He wanted to keep the same low interest rate and just take title subject to having that payment in, and he would just make the payments on behalf of the owner. The California Association of Realtors does not like these loans. I don't like them either. And I think I don't like them mainly because of the one time that we got involved with one of these, we almost got entered into a lawsuit. So I'm not the biggest fan of these. But this is taking title subject to, taking over payments while keeping it still in that other person's name. Let me read a quick question. For assumption, the person buying the property and the seller can just have the private agreement and the seller wants to be compensated. Yeah, she's already paid. So the question was, for the assumption loans, can the seller be paid in a private agreement? Yeah, they could be paid outside. But let's finish up on junior trust deeds. So question, guys, if you pay off a car, what document do you typically receive in the mail? If you were to pay off a vehicle, like what kind of what's that piece of paper you get in the mail that says you are like
Title.
the full owner?
Title.
Title. What color is what's another term
Pink.
for it?
Pink.
Pink slip, right?
Yeah.
The pink slip, the certificate of title. Well, when you pay off a house, you get, if you have a mortgage, if you're in a state that has a mortgage, you get a satisfaction of debt. That's the equivalent. So with a car, you get the pink slip, the certificate of title. If you are in a state that uses mortgages, you get a satisfaction of debt. If you're here in California, you pay off a property, you get a deed of reconveyance. So however you want to memorize this. Car is pink slip, mortgage is satisfaction of debt, and trust deed, a deed of reconveyance. So if you were to pay off your mortgage today, or if you just pay cash for a property, no mortgage lien, anything, you'll get a nice piece of paper in the mail that says deed of reconveyance. Make sense? Perfect, cool. So let's go over some federal policies. We got the Fed. You guys know what the Fed said about the rates like 4 days ago? Say they're going to go up or drastically down?
Up.
They're going up, right?
Yeah, they're going up. They're raising 25 basis points. It's going to go up a little bit more. It is what it is. People are still buying. I'm not worried about it. The three main tools. It's the central banking system, the Federal Reserve banking system. Three main tools. We got the reserve requirements, discount rates, and then the open market operations. And the Fed itself controls our rates. You know, they play a huge factor in regards to our industry. We stay very, very close with our mortgage lenders. I don't pay attention too much to it. I just rely on my mortgage lenders to fill me in on what's going on. But when we talk about our real estate exams, we want to know these two acts. We want to know TILA, and we want to know RESPA. TILA stands for the Truth in Lending Act. So the Truth in Lending Act is this. It was enacted to protect the consumers by requiring the lender to tell the borrower how much he or she is paying for credit. And this is one of those disclosures that say, you know, you're borrowing $400,000, your payment's going to be $3,000 a month. But if you make 360 payments, you're going to pay $700,000 total. This is that paper that's telling you, hey, this is how much it's going to cost you to borrow the money for the agreed upon period of time. Interesting concept, right? The bank has to tell you how much it's going to cost, tell you all the fees. And that's what the Truth in Lending Act is. That's the TILA. Regulation Z also states that the lender must express the related financing cost in what we call an APR, an annual percentage rate. So if you ever borrow money, I'm sure if you read all the disclosures, and it'll tell you how much it's going to cost. And that's what they are required to do. When it comes to RESPA, this is the Real Estate Settlement Procedures Act. This prohibits loan servicers from demanding excessive large escrow accounts. This mainly prohibits kickbacks. So any profit that is unknown by the consumers will fall under the RESPA guidelines. This provides homebuyers and sellers with complete settlement cost disclosures. A settlement cost disclosure is like an itemized breakdown of all the costs and fees associated in your borrowing the money, the sale of the property. Whoever you are doing business with is required to provide you a breakdown of any fees, costs that are associated with the purchase. Seems like a common sense requirement, but the requirement here is the Real Estate Settlement Procedures Act, RESPA, and TILA. So what term is used to refer to a person who purchases a negotiable note without knowledge of any defects? This is going back to my Carla and Uriel. Uriel was the holder in D-course. He was the person receiving the negotiable note, the trust deed, the mortgage. He purchased that from Carla. He was bank number 2. She was bank number 1. He purchased it. They are known as the holder in due course. What is the federal law that mandates finance charges to be expressed as an annual percentage? It's either TILA or RESPA, and that is the TILA, the Truth in Lending Act. RESPA has to deal with kickbacks, providing settlements, settlement statements, and breaking down how much that buyer and seller are going to pay. And it prohibits lenders from excessive escrow accounts. On a trust deed loan, which party holds the legal title to the property? Remember, there's 3 parties: the trustor, which is the borrower. You have the trustee, which is the title company. And then you have the beneficiary, which is the bank. The trustee is the main player in this. The trustee is that middle person. The trustee is the one that's holding the title. They're the one that's going to enact the foreclosure if the borrower doesn't pay. The trustee is the one that holds that title. They are representing the bank. They're going to hold it for the bank. The bank is just going to collect payments. That's all they're going to do. They're going to collect the payments. They're going to lend out the money. They're going to service the loan. But if you don't make the payments, they're going to tell the trustee, hey, trustee, they're not making the payments. Start your process because we want to take our home back. So they hold the title. That's why we have a trustee sale. I'll catch you guys later. Stick around if you guys have any questions. Goodbye.